Here we're going to look at another IAS21 question, moving a small bit on now from the current question, because we now have a parent and a subsidiary. So LA is obviously a foreign operation, a foreign subsidiary in dollars. So we're going to have FX difference 1 and 2 always at the start. In every foreign operation question, you're going to have to translate the financial statements. And when you retranslate them in IAS21 rules, you're going to have that plug figure that's going to be made up of retained earnings, but also your FX differences. The added complexity here we have is now we have a consolidation situation where there's a parent and there's going to be an NCI as well. We'll start to see then how Goodwill comes into it, how FX impacts Goodwill, and how FX impacts the NCI as well. So it's quite a straightforward statement of financial position that's given. You're told Munster, which is the parent, acquired 75%, so that means there's 25% NCI on the 1st of September. So again, we're keeping it straightforward. This was a current year acquisition on the first day of the current year, 1st of September 2012, and we're now at the end of August 2013. So it's only 1 year, so we're not looking at current and prior year differences, which is what we look at in the next question after this. NCI is measured using method 1. That'll be important when we come to Goodwill. So as we mentioned in class, if the NCI is measured at method 1, it gets no goodwill impairment and it gets no goodwill FX movements. So you're just being consistent. If the NCI was measured at fair value, it would get some of the goodwill impairment and it would get some of the goodwill FX movement, which is FX difference 3. And then you have exchange rates at the start of the year, which is the acquisition date. We call that the historical rate. At the end of the year, which is the financial reporting date, which we call the closing rate, and the average for the year, which is just the average rate. And you're asked to prepare this consolidated statement of financial position. So the first working you're always going to do, and it's always going to be a big working, like you have a big disposal working, this is going to be a big FX working. You can't do goodwill or anything like that until we translate this set of financial statements. So we bring it up here, and we have it set up here, working 1, and I just have LA like that. So I have a template left for the answer at the end, which I always advise students to do. Just leave it like that. And then we have our little journals that we'll do down the side, and our bigger workings we keep in a separate page. So your bigger workings like FX, like disposal if you have it, like NCI, like group retained earnings. So the rates you're going to use here then to convert it to nice and straightforward statement of financial position. The net assets at the end of the year, so this would be assets and liabilities, we've just summarized it, will be the closing rate of 2. So that means LA in euros, we put it in here. LA in euros is going to be 150,000. So 150 is your total assets in euros based on IAS21 rules. Assets and liabilities converted at the closing rate. Ordinary share capital is converted at the historic rate whenever you acquire the business. That's a rule under IAS21. Historic rate here is the 1st of this year. That's only because you acquired it on the 1st of this year. If you acquired it 3 years ago, you'd have to use the rate 3 years ago. And that is 2.5. So 100,000 divided by 2.5 is 40. And I always leave this as the plug figure. Now there are 3 or 4 things going on in here. So if you wanted to, you could just try and work it out there. But I usually just leave all this as a plug and I prove it down here what's in it. Because there's 3 elements in this. There's retained earnings before the acquisition, retained earnings after the acquisition, and your FX differences. So in this case, your plug must be 110,000 because you want your total equity and liabilities to be 150 as well. So that's always your starting point of the FX questions is retranslate. So that net asset is going to go in, that share capital is going to go in, and it's going to go to the goodwill working. And we need to split this out then. What's in here? Some of it is going to be retained earnings. Some of it is going to be FX differences. So we need to split out that 110 into its components. And what's in the plug figure? The plug consists of, we did this with the current question before as well. Number 1, pre-acquisition retained earnings at the historical rate. So in our case here, we're told in the question, we acquired it at the 1st of this year, retained earnings were 125, divided by 2.5, which is the historical rate. So of that 110,000, 50,000 is pre-acquisition retained earnings. Now be careful. What do we do with pre-acquisition retained earnings? That's going to the goodwill working. So once we've this working done, a lot of the rest of them, goodwill, NCI, are very similar. You're just setting it up is the hardest part. The second component is, well, in there must be post-acquisition, because we owned it for 12 months at the average rate. Now it's a bit straightforward here because they give it to you. Post-acquisition must be the difference between what was there at the start of the year, what's there at the end of the year. So $75,000. That must be post-acquisition. Exam questions, we wouldn't tell you that directly. We'd expect you to calculate it. Divided by 2.2059, which is 34,000. So retained earnings are now 84. If you put that in there, 84,000. That's made up of pre and post acquisition, and we'll deal with that when we do our normal workings. So some of that 84 is going to goodwill, this 50. The rest of that 84, the 34, that's going to be split between the group retained earnings and the NCI based on their share. So not dissimilar to what we've done in any other question. And that must mean the cumulative FX differences have to be the other plug. So I'll just put this in yellow again to signify it's a plug, and we prove it. So you kind of go on little, you find the plug for retained earnings, you prove it. You find the plug for FX differences, you prove it. So here it will be, this has to be 110 overall. So that means 110 minus 84 is 26. So your cumulative FX differences. Now, to be honest, cumulative here doesn't make much significance because you only have 1 year. When I talk about cumulative in other questions, it's important when you have a prior year acquisition, because cumulative means current and prior year FX differences together. Whereas here we know all of this is going to the P&L because it is all current year. But in other questions, it may be current year and prior year together, and that means it makes it a bit more complicated in terms of where it's going. So the final element of our working one then is, well, let's prove where this 26,000 comes out of. And that's where your FX difference 1 and 2, which you'll have in every question. Ignoring goodwill, ignoring any fair value adjustments, you always have FX difference 1, which is to do with net assets. And as we said before, this is to do with opening net assets. So the opening net assets at the acquisition date, you were translating them at the historic rate, whereas everything else in the statement of financial position has been translated at the closing rate. So what that means is you're going to have a plug difference, which is one element of your FX differences. So it is complicated, it just takes practice. So here we're going to, the opening net assets, and be careful, they were the 100,000 share capital and the 125,000 retained earnings at that date. So they were 225,000. And they were in dollars. And under IAS 21, they're converted at the historic rate, which was 2.5. Under IAS 21, all the rest of the statement of financial position is converted at the closing rate, which is 2. So by definition, you're going to have a difference there because one side of the statement of financial position is at one rate. The other side, which should balance, is at another rate. So that means you're going to have a difference. And that difference here is a gain of 22.5, an FX gain, 22,500. Because the opening net assets are converted at a different rate than the closing. So that's your FX difference 1, which is contributing to net assets. And you need to be able to prove these to get your full marks in the exam. The other difference that you have here is post-acquisition profits. Now again, it's nice and simple in this question because we only have 1 year. So it's not as complicated as you might have in other ones. So what we're looking at is what's the post-acquisition profit? We said it was 75. The average rate, 2.2059. The closing rate is 2. So again, don't mind the 0.3 there. The difference, the FX gain, is 3.5. one side of the statement of financial position, because that's part of the statement of financial position in here, is converted to 2.2059. The other side of the statement of financial position is converted to 2. So by definition, you're going to have a plug, and IAS21 says that is an FX difference. So total FX differences, 1 and 2, which you'll have in every question, is 3.5 plus 22.5. And that thankfully matches our 26 up here. So what we're actually saying now is, when you retranslate the statement of financial position for LA, it is 150 of net assets, which you'll add to the parent. It is 40 of share capital, which you'll adjust in Goodwill. And this plug figure here is made up of retained earnings and FX differences. And they are treated separately. Some of them will go to Goodwill, your pre-acquisition retained earnings. The rest is divvied up. So actually what's in here, that 26 is going to be split between a group FX reserve and split between the NCI. Group FX reserve gets 75% and the NCI gets its 25%. So that's an important one. It gets 6.5. So the FX differences is separated from retained earnings. So you might see a little journal, and I'll explain what it means up here. A little journal for FX is we debit retained earnings of the sub, 26. We credit group FX reserve, 75%. And we credit NCI, 25%. So what that means, if you think about it, I'm saying debit retained earnings to sub 26. And what that means is, of that 110, I know 26 shouldn't be in there. So debited means take it away and leave retained earnings at 84. That's all it means. So you're saying take out the FX and don't just leave it there, because FX reserve under IAS 21 for the group, it's like a revaluation reserve. It has its own line item. Whereas similar to reval reserve for the sub, for the NCI, it doesn't have a separate line item, it's all together. So that's why you lob it all into the NCI straight away. So when you have an NCI, it will always get its share of FX difference 1 and 2. It may not get its difference for Goodwill, as we'll see, and it may not get its difference for fair value adjustment. But for FX difference 1 and 2, it will always get it. So that's your first key working of IAS 21 done. You get the retained earnings, you convert the statement of financial position, you figure out what the differences are, and you allocate them out. Our next working now, working 2, is going to be Goodwill. And you proceed as normal now, based on the information in the question. So you go investment, and we go 75% parent, you go 25% NCI, and you go total. Right? We know the investment in the parent is given directly in euros in the question. They acquired 100,000. So 100,000. We don't know yet the NCI because we're using method 1. So we need to know what's the fair value of net assets at acquisition. And here it's ordinary share capital and retained earnings. There's no mention of a fair value adjustment, which itself needs to be dealt with in IAS 21. But here the ordinary share capital is 200,000. Retained earnings at acquisition date we know is 125. So we know the fair value of net assets at the acquisition date. Now be careful, I've made a mistake already. This is in dollars, you need to use in euros. That should be 40,000 and that should be 34,000. So be very careful about that. This is all in euros. So we're doing 100,000 euros. That means these must be the retranslated amounts. We said the share capital is retranslated to 40. And we said the pre-acquisition retained earnings, my mistake, should be 50. 50,000, because the 34 is the post-acquisition. So it's one thing to be careful about there, and I'll highlight that in a different color to signify they are converted to euros. So you have to do this working first to convert these and get them in euros before you do your Goodwill. So that means your NCI is 25% of 90, which is 225, so 122,500 is your total investment. So your goodwill at acquisition here is 122,500 minus 90. That's important, it's at acquisition. Your goodwill at acquisition is 32,500. So again, that is nothing different than what we've done before. The only tricky element is to make sure you take the converted euro amounts, otherwise it's going to be meaningless comparing euros to dollars. And remember, as we work across the net assets, 90,000, that means 75% of that would go towards the parent. And that means 25% will go towards the NCI. So the only reason I'm doing that is to show that there's no goodwill to the NCI. All the goodwill is attached to the parent. And that's because method 1 was used. Now that's going to be important in the next working that we're looking at. Because there is a thing called FX3, which is to do with goodwill. So under IAS 21, goodwill must be retranslated at the end of each period. So what we're saying here is, this goodwill is at the 1st of September 2012, which was a year ago. So you must have FX difference 3. Goodwill must be retranslated. And how you retranslate it is, you say, and we're going to do a little journal for this. So I'm going to say here, journal 3, or journal 2, sorry. So you come back up here and you say, your J2, goodwill at acquisition, which is 32,500 euro, and that would be at the historic rate, which is 2.5. Right? So technically in dollars, if you want the dollar amount of that, that is 32,500 euro times 2.5. So what you're saying is the dollar amount of the goodwill at acquisition is 81250. IAS 21 says you must retranslate goodwill at closing rate each year. So at the end of each year, you must retranslate that at the closing rate, which is now 2. So if that 81250 is divided by 2, instead of being divided by 2.5, which was when the historic rate was, it would be 40,625. Now remember, that's in euro. So that is an FX gain going from 32 up to 40,625. An FX gain, and we call that FX difference 3. Or sometimes it's called 3A, because 3B is to do with a fair value adjustment, which you would do a similar working. So that has nothing to do with FX difference 1 and 2, because this is a consolidation adjustment which happens after you translate the financial statements. Financial statements themselves, this plug figure only deals with 1 and 2. Once you start having goodwill, you now have to retranslate it. And the key thing is here, the NCI gets none of this, because the NCI, as we said, had no goodwill. If the NCI had goodwill, you'd split that 75-25. So the debit and credit here is debit goodwill, bring it up, 8125, and you credit group FX reserve, the full amount, 8125, 100%, as NCI is method 1. So that's a tricky one. If the NCI was method 2, you would be allocating at 75-25. Right? So just an extra working that you should be conscious of when you're looking at IAS 21 subsidiaries. So we come down here then and we say our goodwill, 8125 extra. So goodwill at the year end will be the 2 added together. And that's the one that's going to our statement of financial position, 40,625. And of course, you could have an FX difference, which is a loss, which would bring down goodwill, and which would be a debit to your group FX reserve. So remember, this was nice and straightforward because this is a current year FX difference. So when we go up here, in terms of our labeling, that FX difference here, that's going to have 3 stars beside it because it's all current year. Likewise, this is going to have 3 stars beside it because it's all current year. So what I mean by that, you're probably going to put an S in it because that's split and this isn't. If you have a prior acquisition, you're going to have goodwill retranslated for 2 or 3 years. So you're going to have to split out current and prior year. Same what you're going to do with FX difference 1 and 2. So having current year and prior year is an added complexity, which we'll look in the next question in a separate recording. So just have that in the back of your mind as well when you're going through it. For now, we're just focused on current year. So we have our goodwill working done. So what we're going to do is try and finish off the other ones. So we're going to look at working 3, which is going to be our NCI. Right. NCI at acquisition from working 2, we said was 22.5. And the NCI gets a number of things. It's going to get FX difference 1 and 2, which is from journal 1. We said we're going to give them 6,500. And remember, this was an FX gain. Up in journal 1, and we credited the NCI. That means you are increasing the NCI. The other thing that the NCI gets here is their share of post-acquisition profit. And we said post-acquisition profit 1 year was, now be careful here, a lot of students will put in the 75,000, that's in dollars. You need to use the post-acquisition profit, which we said was 34. The 50 of the total of 84, that's been used in the goodwill working, 50 here. The 34 then is post-acquisition. So you put the 34 down here, and that's going to get 25% share, which is 8.5. So your NCI at the year end, which is very similar to what you've done in any other working, only that you have a bit of work to get to the right figures. You're going to add them all up. And the NCI at the year end is 37,500. Similarities, but it's just a matter of making sure you're happy enough with where the figures are coming from. So working 4, let's look at the group retained earnings. Similar logic again. The group retained earnings starts with the parent at year end, as it always does. We know the parent at year end here is nil. Munster Acts, very simple, has none. We know none of the FX differences go to group retained earnings. The FX differences go to a group FX reserve, which we'll do as working 5. So that's a difference. Any of the difference go into the NCI because it only has one line item, but they're kept separate for these. So share of PAP, exact same as above. If the NCI gets 25%, the parent must get 75%. So in this case, it's 34 times 0.75, which is 25. That's quite a straightforward one then. Group retained earnings at year end is just 25.5 because there's nothing else. Now, an exam question, you could have unrealized profit, you could have impairments, etc. All that will go in. But we're just focusing on the basics now, so why we're not overly complicating things. And the last line you will have working 5 group FX reserve, which is its own line item in the equity section. Right? And we have now their FX difference 1 and 2. That's coming from journal 1. We said there that's going to be 19.5. And we said FX difference 3 from journal 2 was 8125. So let's have a look up here just to double check that. Yeah, 8125 credit and a credit. Both of them are increasing the reserve. What I want to show is that's 75% and that's 100%. The reason being goodwill is NCI is measured at method 1. If it was method 2, everything would be 75%. So your group FX reserve at year end is 27,625. And that'll be a separate line item in the equity section. So a lot of this is similar to what you've done in weeks 1 to 6 in class, but it's just a matter of layering on the FX complexities, which you need to do first. That's your big working you'll be doing first. So finishing it off then, we know the investment in sub is gone. We know the net assets of LA, remember you've retranslated them, they're no longer $300,000, they're now 150. That's where it comes from. And we said goodwill at the year end from working 2, goodwill is 4625. So I'm just going to put in there goodwill working 2. So the examiner will see where it comes from. So total assets 190. Sorry, that should be LA. So what I'm doing here is I have to do my adjustment column. adjustment, and then do group. It's more logical. Take these and copy them across. So you have your adjustments and groups. So an adjustment here, that should be in this column, 4625. So, and the investment in sub is gone because that will be written off against the goodwill. So you have no investment in sub, 150,000 assets, and 4625 goodwill. So 190 total assets for the group. The share capital of LA we said was converted to 40, but we know that is eliminated then. That 40 is eliminated on goodwill. The retained earnings we said were 84. I'll leave another couple of lines here. And we said FX reserve, well actually we said retained earnings are 110, which is the plug figure. But we're going to split those out. We're going to have now a group FX reserve, and we're also going to have NCI. So you can reference there, that's working 3. FX reserve is working 5. Retained earnings is working 4. Just to show the examiner, share capital should only ever be the share capital of the parent, the 100,000. Retained earnings we said were 25,500 from working 4. FX reserve, if we go down to working 5, we said it's 27,625, just the group's share. The NCI share has already gone in to their NCI line item, and the NCI is 37.5. So that means when you tot them up, you get 190,625. Alright, so there is a lot of work there in terms of figuring out where the figures come from. But the main part is the starting working, translating the subsidiaries' financial statements, getting the plug figure and proving that plug figure. And after that, a lot of it is very similar once you have a euro set of financial statements. So part B of this question is giving you a P&L now, and you're asked to translate this as well. Now note, that's where the 75 comes from. So you must have made 75 for the year. When you add that to the 125, you have the closing balance. So if I wouldn't have given you this in an exam question, I'd expect you to work back from the 200 and take off the 75. But the closing consol P&L, now we can only do for LA here because we don't have Munster's P&L. We assume it's nil. If we come down here to show you what it'll look like. So that's your LA. Then you're going to have LA in euros. And we're going to convert that 2.2059 because that's the average rate across the board. So for your income and expenses, you always use your average rate, which is 2.2059. So I'll just do those across, just for illustration purposes. And we'll tidy them up. So we'll just get this and we'll format them as well. So that means, and let's see where the 34 comes out of. We've done the 34 above. If you go back and you look at your working one, we said the post-acquisition retained earnings are 34,000 euro, and we use that in our figures. And that's where it comes from, the P&L, where everything is converted at the average rate. We call that AR, or average rate. That's where the 34,000 will come from. Now, the key thing to watch here is that's just the starting point. Because if you remember, we had FX differences. So you're going to have other comprehensive income. FX differences. Right? So you have to be able to remember to put these in when you're looking at group financial statements. Any current year differences, and it's just simplistic here because everything is current year. If we go back up, the 26,000, the full amount is an FX difference, and it'll be split between the group and the NCI. Likewise, the 8125 is an FX difference. So the two of them added together are your FX differences for your P&L. The reason it's simplistic here is they're all current year. If there's any prior year, you'd have to do more workings to split it out. So here, that's going to be 34,125. So your total comprehensive income for the year is 34,125 plus 34. Let's just tidy that, it's all the same. Calibri and 12. Right. So your total comprehensive is 68,125, and now you have to do two splits. You have to split between the parent and the NCI, and the parent and the NCI for profits, and the parent and the NCI for other or total comprehensive income. So you have then profit attributable to parent and NCI, and you're going to have the same then as a separate one for total comprehensive income attributable to parent and NCI. So the first thing we need to do is divvy up that 34. Now that's straightforward because the NCI, there's no other adjustments. This is going to be 34,000 times 0.25. So the NCI gets 8.5, which we've done as before, and that must mean the parent gets the difference, which is 25.5. Now, I said this is unusually simplistic because we've no other parent P&L. We're just looking at the sub, but you have to split it out. Now, here's where you have to be a bit more careful. In allocating the total comprehensive income, we now need to allocate this 34 to the parent and the NCI. So here, the NCI is going to start with the 8.5, which it has up here, and it's going to get 26,000 times 0.25. That is its share of FX difference 1 and 2 only. It doesn't get 25% of the whole amount because we know the goodwill is only attributable to the parent. So here, in terms of an allocation, the NCI is going to get its share of 8.5 always, because you're just adding to that, but it's 26 times 0.25. So 15,000, and the parent must get the difference. So the 68 minus the 15. And that is your finished P&L. So remember, when you have FX differences in a subsidiary, you will always have OCI. That's where they go the full amount, and then you figure out how much you need to allocate to the parent and how much you need to allocate to the NCI. So there is a bit of work involved there, and it takes practice. The more questions you do, the more comfortable you'll be with it. So what I've given you in the solution pack as well, and I'll just show you this, trying to link between the P&L and the statement of financial position. So what we're going to look at is, remember these items, we'll come back to them, and go back up here to the statement of financial position. Remember these closing balances. We're now going to do a consolidated statement of changes in equity just to see, does this make sense? All right, we'll do it here just for clarity. So we're going to have consolidated statement of changes in equity. And you're going to have ordinary share capital, you're going to have retained earnings, you're going to have FX reserve, and you're going to have NCI and total. All right, so we won't overly complicate things. And just put those in bold. You have your opening balance on the 1st of the 9th, 2012, and you have your closing balance on the 31st of the 8th, 2013. And we said with consolidated statement of changes in equity, you always start with the closing balances. And they're in here. 100,000, 25,500, 27,625, and 37.5. So that's my total equity is 190,625. And remember, your FX reserve is a separate column. Like if you had a reval reserve, it would be a separate column as well. The only movements we had during the year is TCI for the year. So this is coming from your P&L. We had no share issues, we had no talk of dividends. So this is the one key movement we have to put in, and you always have that. But just make sure you put in the right columns. So if we come back down here, we're saying total comprehensive income, the 15,000 will go to the NCI, right? Not the 8.5, the full 15 where you combine together. The 25.5 will go to group retained earnings, GRE. This will go to NCI. And the difference here between the 25.5 and the 53, the difference, which is 27,625, goes to FX reserve for the group. So that's important. You don't just put that all into retained earnings, because that is made up of the parent's share of the 34, which is 25.5, and the parent's share of the 34,125. Now remember, the parent's share of that is 26,000 times 75%. So their share of FX difference 1 and 2 plus 8,125 times 1, 100% of the goodwill. and that's your 27,625. And we've done that in week 1 to 6. Be careful when you're taking these figures and putting them into the statement of changes in equity. So if we come back up to finish it off, this is 25,5, this is 27,625, and this is 15, which is total comprehensive income for the year, linking to your P&L of 68. So that means my opening balance in ordinary share capital should be 100,000, and that's fine because it hasn't moved. Opening retained earnings should be nil, and remember that will make sense because at the start of the year you didn't have a subsidiary because you only bought at the start of the year. That means you only had the parent, and the parent had no retained earnings. So that makes sense. It's unusual, but it makes sense. FX reserve is nil. That also makes sense because you had no FX reserve at the start of the year because you didn't own the sub. And the last thing then, we're kind of saying, well, 37 minus 15 means 22.5. I didn't have an NCI at the start of the year because I only acquired this on the first day. What you should remember from your earlier studies is you should have an acquisition line coming from working to Goodwill. The NCI was 22.5. 22.5 plus your 15 is your 37. And that means my NCI at the start of the year was also nil, which makes sense because I only acquired the subsidiary at the start of this year, which means the opening balance would have been nil and we increased it at the acquisition date. So it is quite tricky, an FX reserve question in IS21, but the key one is get the working one right. If you get the working one, FX difference 1 and 2, a lot of similarities happen after that. You might have 1 or 2 extra workings, but everything else is quite similar to the vanilla questions we've covered right throughout semester 2 already. Right, so make sure you go back and you're comfortable with the current question, the basics, go on to this, and the next recording then we'll look at an acquisition again, but we'll also look at current and prior year FX differences.